assess the scenario that the slew of economic data this week has actually set up for us. Negatives first, the Kagiso PMI numbers coming through, showing that manufacturing has slowed markedly. We're back to below that 50 mark, and combine that now with CPI outside the target, and we're looking at a pretty dire situation on that front.
Yes, and I mean, I think the focus there, I mean, you can worry about inflation. So you have these two sort of conflicting sources of information. One showing that inflation is high, at least from November to December, it's sort of, was unchanged. So there was a little bit of consolidation there, but inflation is above the target, and there's no doubt they'll be uncomfortable about that. And then on the other hand, you have this weakness in the economy being reconfirmed. It's not new. We've known that it's been there, and we also know that there are significant risks to economic growth going forward. So these are the two things they will look at. I think when they look at inflation, it is high, it is above 6%. At some point, it is going to become unbearably uncomfortable for them, because it is, after all, their mandate, it is, after all, their job to control inflation between 3 and 6%. But they will also break that down, and they'll have a look at whether there are any signs of secondary inflationary effects. And if you look at it, there really isn't. If you look at inflation on semi-durable goods and durable goods are still falling. Semi-durable goods is contained to about 1.9%. So that is still well contained. So yes, the sources of inflation in this particular environment is important, because it is mainly cost push pressure, it's higher food prices, it's higher fuel prices, it's higher administrative costs, of which electricity is a big chunk. So that's largely out of their control. The bit they've got to prevent from occurring is that secondary effects, and there's no real evidence of that yet. So I think that will make them a little bit more comfortable on the inflation front. Then the real concern here, the real issue here, is the domestic economy, and on the production side, it's been weak for over a year. It now looks like it's continuing and in fact slipping. And we know that that's a big risk, mainly because of our exposure to the Eurozone, mainly within the manufacturing sector. So that's probably going to continue and get worse, because there are signs that Europe are in recession.
And yet, if you drill down into those PMI numbers that came through yesterday, I mean, we had expected business conditions, and that index rising by 6.3 points to 61.3. So there's some disconnect there, because it suggests a belief in better times ahead.
Yes, no, that's true. But I mean, I think that is the nature of business. Things are tough, but we do believe at some point. and business people are eternally optimistic, really. I mean, and you have to be. If you're in this, if you're running a business, you have to look forward, and you have to expect that you're going to be able to make it, and that you'll be able to do well. I mean, else what's the point in existing? You know what I'm saying? So you always find that in confidence indicators. That is a weakness of it.
And of course, we've also got the upside risk of the rand to consider. I mean, we've still got that moderately weak. We saw it moving through 8, yes, but still at the mercy of the euro dollar for the most parts, and that reflective of downside rather than, strong risk on trade, and that being supportive, especially where you've got foreigners slow back into emerging markets like South Africa.
Yes, no, that's true. And I mean, we've been seeing quite a few international banks coming through, and they all are keenly interested in whether we think South Africa will be downgraded or not. So it is an issue as to what kind of foreign capital inflows we will see this year, and how that will impact on the rand, what level of risk aversion will be there, and of course that will be dominated by the whole play out that we might or may not see in Europe. And if there's risk aversion, there's always a very good chance that the rand might take a smack.
Well, we've been looking at the negatives. Let's take a look at the positive side of things. Retail sales numbers. I mean, it surprised a few ticks to the downside, but the overall run rate remains to be pretty buoyant on this end of things. Still enough to say that the growth we are seeing is more so driven by the consumer side of things as opposed to the production side of the economy, especially if you're putting it up against the PMI numbers.
Well, I think that's what they'll focus on. The weakness is on they'll look at economic growth, and there's where the downside risks are significant. They mainly relate to the production side of the economy, but the consumer is the only thing keeping this economy going. So if you're going to move on interest rates, you're going to make them more vulnerable. They may be spending, but they are still not financially 100% comfortable. Debt levels are still high. They're chipping away at it. They're doing a fairly good job at it, but it's still high. And if interest rates were to go up, most consumers would feel it. Plus the effect that the rising cost on essential goods have on disposable income, and you will very quickly see the consumer change, and you'll quickly see spending starting to fade. And I think that consequently the focus will be to keep monetary policy accommodative as long as possible, possible.
Of course, we had, looking at the macro backdrop, a domestic picture here that looks to be pretty much the same as it was in the last meeting, perhaps a little stronger external dynamic coming through from the likes of the US and China as well. We've seen some positive economic data filtered through there. But with that, consensus across the board seems to be that we're going to see rates on hold at 5.5%, the right move to be taking in your books?
Yes, I think so.
Okay,
yes.
So not much noise about hiking or cutting at this time. Let's take a look at rhetoric that you're expecting to hear as we move forward, because that is what the market's going to be focused on.
Yes, I mean, I think they will again emphasize on the growth side. They've got two elements here. They've got the inflation side, which is negative and putting pressure on them. They've got the growth side from an interest rate perspective, which will keep it either steady or promote a cut. So I think that they would essentially focus on the growth side. The things they will highlight is the risk from the Eurozone. So you'll probably hear quite a lot of mention of that, and that contains quite serious implications for certainly our production side of our economy, therefore our exports, and therefore also our current account deficit. So I think that will be a feature they will highlight again. On the inflation front, I think you're going to see mention certainly of the Rand. The Rand is the wild card in this. It could change our assumptions depending on how the Eurozone plays out. So they will have mention of the Rand, and they might also mention some concern about oil prices and the conflict and tensions we are seeing in the Middle East again that is pushing oil prices up. However, having said that, if that conflict sort of fades, there's nothing really supporting at this point oil at the current levels where it is. So, going forward maybe 3 or 4 months down the line, you could actually see that become a factor that is positive for inflation and bringing inflation down.
Well, Nicky,
so those are the things I think they will highlight.